Yeah.
And the second question is about WIX. What do you think about the mention, or that they mentioned that they will stop giving guidance?
Which company, sir?
WIX.
WIX.
That they say they will stop giving guidance because they are thinking the moment at the moment it's very difficult for them to see the evolution, or how is it, what are the trends, while it is a subscription company.
Yeah, and then on WIX, I mean, I guess it's not necessarily specific to WIX, but I would just say that, for those of you who aren't familiar, WIX is a company that regularly provides quite detailed guidance to investors on what they expect for the coming quarter and for the coming year. And there's obviously a degree of uncertainty at the moment, as sort of they benefited a lot from COVID, people staying at home, building websites, and now kind of people are slowly going back into the real world. That's sort of, led to a slowdown in their business, obviously a greater degree of uncertainty, as a result of which they've decided not to provide guidance anymore. I'm personally not a fan of guidance. I think there's a lot of companies that get into a lot of trouble by providing guidance. I recently read a book about GE called Lights Out, which was a great read. I can recommend it to everyone. And at the core of GE's problems was effectively this guidance that Jack Welch gave over decades, that they would grow 20% every quarter, and it just led to effectively fraudulent behavior. So I'm not a fan of guidance at all, and if it was up to me, I would advise all of my companies not to provide it. But if you're going to provide guidance, then you can't just stop when when it suits you. So if they decide on an ongoing basis not to provide guidance, then that's fine by me. If they decide they want to continue to do it, and then they should be consequent and continue doing it. So that would be my message to management. But I'm actually going to Israel next week to visit with them, so I'll pass that message on to them.
My question is about WIX and stock-based compensation. And we'd spoken about this briefly around 2 years ago, where it's a great tool to attract talent, but it's also a real expense. And around that, 2 years ago, maybe it was 10% of revenues. And I think you had mentioned with scale, you should see maybe that percentage going down.
Yeah.
Over the last 2 years, that's sort of gone up maybe to 17% or so. So just your thoughts on that. And secondly, I guess with the stock price coming lower, how do you think that plays into attracting and retaining talent? Because I guess it's an important piece of motivating employees.
Yeah. So obviously as a long-term investor in a company, I don't like to see dilution. I prefer the opposite, actually, where companies are repurchasing their shares, so my stake in the company gets bigger over time. But the reality of tech companies, and especially younger tech companies, is the major motivating factor for young, talented people to go and work there is the prospect of stock-based compensation and the additional upside that can come from participating in the company if it becomes really successful. So I don't think you have a really choice on that. But the way I kind of think about it is, when a company does mature, stock-based compensation will also normalize, and and I think you've seen that in a lot of the old, the first or second generation of tech companies. So I remember when I first invested in Google, there was a lot of concern about stock-based compensation and dilution and stuff. And of course, as the company has matured, that's sort of normalized, and you see that at other companies. So the bet would be that that over time that does normalize. But that's an important point, because obviously, if the shares, if your stake in the company is being diluted by, say, 5% every year, then the earnings power needs to grow by 5% just to kind of just to break even. And then in terms of kind of the decline in the share price and what that means in terms of employee motivation, fortunately, this hasn't happened in a vacuum. Pretty much the entire tech sector has really declined very rapidly in price. You don't necessarily see it when you look at the NASDAQ. The NASDAQ is very heavy in large cap companies like Google and Apple and Microsoft and stuff like that. So the NASDAQ looks comparably stable. But if you look under the surface, I saw a statistic recently that over 40% of the companies in NASDAQ have lost over 50% of their market value this year. Or not this year, from the highs, I think. So it's pretty dramatic, and it's happening under the surface. But it's sort of, fortunately, it's happening to WIX's competitors as well. So while that's the case, I think that should help them.